Hello, today I'm joined by Mark Barnett from the Tellworth UK Income and Growth Fund. So Mark, you launched an income fund just as interest rates started to go up. So now you're having to compete with relatively decent returns on cash. So in your opinion, why should someone invest in an equity income fund rather than simply just putting their cash in the bank?
Well, to be fair, that's a very fair comparison, and this, as you say, for the first time in a long time, cash is now a competitive asset class to other assets, and obviously within a diversified portfolio, perfectly reasonable. To be fair, throughout most of my career, equity income investing, cash was always a realistic option. It's only since the financial crisis that collapse in interest rates has meant that cash has been eliminated from the equation. What you won't have with cash, of course, is you won't benefit from the dividend growth. And if we find the right companies and we're invested in the right businesses, then over time the dividend growth will mean that capital values should rise, and you'll benefit from the growth in that dividends long term. So what we're really thinking about when we think about the equity income mandate, and this is something that's consistent with my career, is actually businesses not that just pay dividends, static dividends, but actually businesses that pay dividends that can grow over time. So dividend growth is the key component.
Now, we've seen double-digit dividend growth for quite a few companies this year. Is this trend likely to gather pace as management do more to make their shares attractive versus the returns that you can get from cash in the bank?
Potentially that might happen. My sense is that if you look at the cover levels across the market, they have been significantly rebuilt post the pandemic. A lot of businesses went into the pandemic with low levels of dividend cover. In fact, that was often a concern leveled back at me when I was talking to clients around the attractiveness of the UK equity market and the dividend from the market. People were worried about cover levels. Actually, what you saw over the pandemic was that cover was rebuilt significantly. Many businesses either had to cut their dividends, were forced to cut their dividends, or the third option was chose to rebase as a result of what was happening in the broader market. So I think from this point on, dividends are better underwritten, and therefore I would see that management teams that are growing by double digit are doing so from positions of strength and are unlikely to want to see cover levels run down. So I would actually go into equity dividend investing with the belief that dividends now are more secure than they were, say, 3 or 4 years ago. So that's a sign of confidence.
Your fund is targeting income and growth. Does that mean that you're happy to blend a mixture of traditional income stocks with names that don't pay dividends or perhaps are even loss-making businesses?
My idea about dividends, as mentioned in the previous answer, is around dividend growth, and definitely that is consistent with what I've done in my career. I am not just targeting businesses that pay a dividend in line with the market or in excess of the market. I'm happy to buy companies that pay a lower yield today in the belief that that's going to grow, accelerate over the next few years, and then that will drive capital values in the business. So I'm flexible about the kinds of businesses I'm prepared to own. Clearly, if you do own something that doesn't have a yield, that does bring the average down, so you need to be cognizant to get into the income sector. You need to have an average equivalent to the market. But I do want to own some businesses that have the potential to be good dividend payers in the future. It's just that at this particular point in their maturity cycle, they're reinvesting the excess cash. The moment my portfolio is 45 holdings, 2 of them don't pay dividends. One of them is very similar to the way you described it. It's called PureTech, which is a life sciences commercialization company. Again, reinvesting everything into the technology, into the development of the healthcare technology. And the other one is Watches of Switzerland, which is a retailer of high-end watches, which is in strong growth mode and is expanding both here in the US and Europe. So there's a lot of capex going through that business. But generally, I'm happy to hold a blend.
40% of your fund is in companies worth between £1 and £5 billion. Now, I guess the part of the market people would know better is midcaps. What's the attraction with these types of companies?
Well, over time, mid-caps have been shown to outperform. Mid and small have outperformed large. The law of large numbers often means that large companies struggle to continue to grow at the same rate. You know, that's kind of mathematics, if you like. I so believe that there is plenty of income that goes unrecognised outside. I mean, the UK market people tend to think of as an income market, which is correct. It's generous dividend-paying companies, but oftentimes it's just surrounding the kind of more obvious income paying businesses like consumer staples companies or oil and mining. And actually there is plenty of income to be found further down the market cap scale, so that's another good reason to own it. And the final reason is, you know, I sit in a firm, Tellworth, which has a historic specialisation in mid and small companies, and there's some really interesting ideas that my colleagues are putting forward for inclusion in the portfolio. So I'm taking advantage of expertise that sits around me in Tellworth.
Nearly 17% of your fund is in companies worth less than £1 billion. Now, there's a lot of market nervousness around smaller companies at the moment. People are worried that funds are not going to be able to sell out of these stocks if something goes wrong. Why are you taking this risk of putting 17% of your assets in this part of the market?
The liquidity issues that you highlight, we stress test regularly, and I'm comfortable that liquidity in the portfolio and the sort of time to realise the cash is definitely realistic. You know, it's not an issue at the moment. Portfolio is pretty small, £20 million, just over, and so the capacity to be able to own some smaller companies and make that a meaningful part of the portfolio is definitely relevant for a portfolio that size. As the portfolio grows, that may have to change, but one of the advantages of being a small fund is that you can do that. And so again, not wishing to miss out on some interesting investment opportunities at the smaller end, the portfolio is trying to take advantage of that. I do accept that there is less liquidity, but I don't think that should be a concern for me at this point in time. One thing that we can observe is that the rating on smaller companies is at a discount, in part because lots of fund managers have had to sell up and move up the market cap scales. They're less well covered by the stockbroking analysts, and that offers an opportunity. And the number of bids that we're seeing, funnily enough, particularly in the smaller end over the course of this year, suggests to me that value has been spotted by trade buyers and by private equity that's deploying it in that area.
Mark Barnett from Tellworth UK Income Growth Fund, thank you very much for joining us. Thanks very much for watching.